So, midcaps, otherwise known as the cheapest growth area of the S&P 500 and the United States as a whole. Right now, you can see that there's a tug of war happening in the market where some days AI concentration outperforms while everything else kind of sells off as capital rotates and the AI trade pulls and sucks that money out of the other areas. Other days, like last week, we see AI names sell off into, I don't know, bad earnings, narratives that come up. Today we had the 500 billion injection backstop from Nvidia towards OpenAI. During those times where uncertainty drives the AI trade, these names, the mid caps, the real economy stocks, tend to outperform. And we see it in software, we see it in materials, industrials that are not related to AI. So that's why today I'd like to cover the potential opportunity within that rotation into the mid caps asset class. So without further ado, let's get into it. This is, first of all, a great asset class. It's not a trade, though, until three things fit the perspective, it fits the narrative, and it triggers the rotation into what I believe is going to be outperformance out of the mid caps. So, first of all, the setup. Right now, mid cap growth, as far as earnings, is the same or at par with the S&P 500. Yet, we are at the widest valuation discrepancy or divergence since the latest bear market, which was 2022. The same happened in the Great Financial Crisis, in COVID, and the dot-com bubble. Every single previous market peak where breadth has not been a part of the overall rally, this tends to happen. A rotation back into the real economy, rotation back into mid caps. Now, the second part is there's an insulation right now. We have a local first theme happening in the US where companies that have 70% or more of their revenue within the US, domestic businesses, they're tariff proof. They're not going to be affected by tariffs as much as multinationals. They're agnostic to AI since a lot of the services and products they provide are outside of the scope of AI's abilities and capabilities, right? So these facts and characteristics of the businesses themselves arm them with pricing power, arm them with this sort of moat that has not been preferred during the AI race. And third is going to be the drivers, right? We have this setup, but what actually triggers the rotation? And I think there's three macro forces that explain almost all of the price action in ETFs that cover mid caps, such as the IWR and MDY. These are going to be the manufacturing PMI, high yield spreads, and the yield curve, which is the 10-year minus the 2-year. So we're going to get into how these are driven and statistically how much of the price action it drives. And then fourth and final, we're going to cover the trigger, which is the catalyst. Being cheap alone is not a reason to buy. You have to have everything I've already covered and then the reason why it rotates. And we're going to cover that later in this presentation. So let's get into the setup right now. So we have the mid cap growth is right alongside the large caps, right? So you have this chart from the LSEG and you have the Russell 2000, which is small caps. They're not growing the overall EPS for the next 12 months. As far as the expectations go, they're not there, right? They're growing about 10% or so for the next 12 months. These are the expectations, right? So this is at the end of 2025, and that hasn't changed that much. When you have the Russell mid cap, essentially the area I'm interested in, they're growing their earnings roughly by 30%, or at least that is the expectation that was set at the end of the year. While overall the S&P 500, which we know is roughly 50 to 60% concentrated into these mega cap AI names, they're looking to grow by 40%. So there's a 10% discrepancy, which is really not that much, right? The mid caps and these concentrated AI mega caps are growing at the same amounts, right? So fundamentally, they should be trading equally. They should be valued in a very, very similar manner, and that's not the case. Uh, so again, same growth, but you pay much, much less for it. So you have the mid caps trading at roughly 20 times forward PE, while that forward PE is looking to grow at 30%. And then the S&P 500 trades at roughly 23 times. This was, remember, end of 2025. By now, it's roughly 32 times. So a big gap of roughly 10 to 12 times with the same earnings underlying, right? So this is again the widest gap since 2022. The same levels were reached during the COVID crisis, the 2008 financial crisis, and dot-com. So whenever that happens, as you can see in this chart, that tends to revert very, very fast, aggressively, whatever adjective you want to include here. But yeah, it happens every single time, especially when the growth narrative is sort of the same as we have right now, right? We have forward EPS growth looking to be the same around the mid caps and the mega cap AI concentration. So why is this spread existing, right? And I think it's all because of a narrative that is not being fulfilled, such as the other narratives that have formed around software and no change in economics whatsoever. So at some point, the market has to come back to its senses and say, well, this doesn't make sense. This gap shouldn't exist. And then we reprice accordingly. So the insulation that I talked about is, these are local first businesses, and the chaos around them doesn't really affect them, right? So 70% plus of US revenue, that's what I'm looking for, right? So this is not applicable to all of the mid caps. I'm just telling you the ones that I'm looking for. And I'm filtering for ones that have that 70% plus isolation as far as revenue driven within the US. Secondly, I want them to be AI agnostic, right? If you have, let's just say, an HVAC business or a plumbing business, right? Just to say something out loud. That's not going to be affected by AI whatsoever. You still need the service, right? What you might see is AI amplifying margins, right? Reducing costs of, let's say, marketing, of operations. But the business itself is not going to be affected negatively by AI. That's what I'm looking for as well. And then pricing power on inflation. If we do see the call options on inflation fulfill as far as the effects from Hormuz, as far as what the Fed decides to do, as far as how massive AI investments drive inflation higher, I want to see the pricing power stay, right? You can see it if you have a local business that derives all of its revenue or most of its revenue from the US, and it is agnostic to AI. Usually and historically, inflation has been good for these businesses because they can pass down costs into the consumer without a lot of the market share or demand falling. So that's what I'm looking for as well. Three things. That's the filter. Whatever I find, I'll relay back to premium members of Offside Capital. So make sure you're signed up. You're going to get 50% off for 3 months. So you can check us out, see if you like it, and stay from there. Or part ways and figure out what you do from there. But these are the three filters. Whatever I find is going to be relayed back to you. Now, here's the real question. And, it all sounds great. We have the three filters. We have the setup. We have the divergence in valuation with the same amount of growth. But when does it pay? Right? When do we think it's going to actually take place? And we have three economic drivers right now. Historically, these have been extremely important for the mid-cap ETFs, which are the IWR and NDY. So you can look them up and spread these relationships if you like. If not, just know that high yield spreads, which is the Bank of America High Yield Index, derives 72% of all the price action within those mid-cap ETFs. Then comes the manufacturing PMI, which drives 80% on a 1 to 2 month lag basis on the mid-caps, right? So if you have the mid-caps going up or going down, it's usually because the PMI has been going up or down by 1 to 2 months consecutively. And right now we have a PMI expansion. It's been over 4 months of consecutive expansion readings. And high yield spreads are pretty low. So essentially this should be a very bullish setup for the mid-cap trade. Now we have third and last driving 35% of the price action is the yield curve. So you have the 10-year minus the 2-year. It essentially gauges how hot or cold the credit market and the underlying economy is getting. So right now we have to pay attention to what the curve shape is saying as far as the economy, because when it cools down, these companies again are so centered on domestic business that they see the massive effects first, right? The multinationals can mitigate the effects of a cooling economy by increasing investment or relying on their international business. These mid caps don't have the ability to do so, so watching the yield curve and what it says about the economy matters a lot. Now, these are the drivers, right? They're not the signal. What they do is the signal. So right now we have the high yield spreads. They're the tightest they've been in this entire cycle. As you can see, here's my regression test to show you that 72% of the price action can be explained by the changes in these high yield spreads. So this is not the signal. The fact that they're so tight and low is not the signal to buy. We want to buy on massive deviations. We want to buy when everyone else is panicking. So that's why I say the spike is the signal. And as we are seeing right now, Oracle is looking to default on its debt according to credit default swaps. These same CDS products are spiking for Amazon, Google, Meta. A lot of the hyperscalers, the market is betting they're not going to be able to take on more debt. That debt is going to be downgraded because of the falling liquidity and all the mess that's happening around the AI. So when that happens, fortunately or unfortunately, that spike in the rising risk around credit is going to deliberately drive down mid caps, and that is the signal that I'm watching for. Remember, 72% of the price action is driven by these movements and spreads. So when high yield spreads and credit spike due to the risks that are happening in AI defaults, I think that it could give us the ultimate opening to buy into the mid cap story at a very, very attractive discount. Now, then we have the manufacturing PMI. And as you can see, the red line in the PMI, that is the expansion and contraction, right? So this isn't the absolute level of the PMI. This is the level away from the 50 mark, which is the neutral, right? No growth, no expansion. And as you can see, every time we begin to expand by a factor of 5, 8, 10% and more, the mid caps and the blue line tend to rally by a hefty amount. And then vice versa when the PMI slows into contraction. So what I'm waiting for here is, well, we already have 4 months of consecutive expansion on the PMI. It is accelerating toward the 5% mark. So we're looking to have 55% plus readings on the PMI. That is essentially a good tailwind for the mid-cap trade. So we have the high yield spreads are tight. Now we have an expanding manufacturing trend. So 2 out of 3 are already bullish. Now the timing, again, I would like to wait for the spike in the credit spreads to take advantage of this tailwind in the PMI and buy the mid-cap. So the setup is there. It is bullish, but not yet. Now, the third driver is the yield curve, right? This tells you which kind of move is coming into the economy. And right now, we have a bull steepener, and we're shifting back and forth between a bear steepener and a bull steepener. And sometimes we get a flattening. But essentially, right now, the 2-year is rolling over, and the Fed is looking to ease, right? I know that Kevin Warsh has been saying a lot about hiking rates and whatnot, but the yield curve is saying something different. And I believe it is because of the side effects and the contagion effects of the Oracle defaults, of everything else that could default on the back of all these bad loans that are happening around data centers, GPU-backed loans, and all the leverage around the AI trade. So again, the economy is saying one thing, the curve is saying another. So we'll have to see why this divergence exists and whether it realizes. And when it does realize, I think it'll be through the high yield credit spreads giving us the opening, right? So again, this drives only 35% of the price action in mid cap. So I would look at it more as what the yield curve is saying and how does it materialize, like I said, in the spreads, which do drive a lot more of the price action. So now the backdrop, right? We have inflation. Like I mentioned, I want to see companies that can pass down cost and where inflation heating up is actually good for these businesses. And right now we could see the mid caps in blue again, in red, against the CPI number. So whenever CPI goes up, you can see that mid caps go up with it, and vice versa. Because inflation, as you know, is good for business as long as you can pass down cost. And the only way you can pass down cost is by staying locally competitive, domestically competitive. Otherwise, a multinational can just start importing stuff and outsourcing work and products to other nations that could do it cheaper. So again, this is part of the filter that I'm applying into the mid-cap space to find the best opportunities and deliver them to you. So now the triggers, right? Again, cheap is not a catalyst. We have to have the exact sequence that I'm breaking down here for you. So right now, we have no trigger. We only have the setup, which is the valuation and the growth driven divergence, right? So we could own some of the great hardware, aerospace aftermarket. We just saw defense in Lockheed Martin. It went up 10% on earnings. Materials like Cleveland Cliffs, they're doing great, right? This is part of the real economy, though they're not as exposed to the medcap space, which is why I'm waiting for confirmation. And confirmation would be a second soft core inflation print, right? So we're getting CPI next week, I believe, and then we're getting PCE this week on Thursday. So a second or third consecutive soft print could be the first signal to start making this rotation happen, to start weighing in more on these ETFs like MDY, IWR, IJH, etc. Now, I don't say that this confirmation is the time to buy specific stocks yet, only the ETFs, because I am still waiting for that high yield spread spike to happen. And as you know, that drives 72% of the price action. So if we do get that spike, I think we could get the ultimate opening to buy individual stocks and not the ETFs. Now, the pivot. There's a pivot happening in the yield curve, which needs to happen when the 2-year yield rolls over and the curve bull steepens, right? So that's where regional banks could have increased profitability, rate sensitive cyclicals like automotive, building materials, and groceries and all of that, like Kroger, not a Walmart, right? International. We want a Kroger, local. Sprout Farmers, stuff like that. That could see a lot of benefits from a bull steepening in the yield curve. So that is when I would really start to watch out for individual stocks, even if we haven't gotten the yield curve or the high yield spread spike, right? The yield curve the yield curve itself is enough to get us on that pivoting rotation into individual stocks. And then once we have the consumer recovery, so a consumer confirmation of what's happening in the yield curve, we're going to have to see the University of Michigan consumer sentiment recovering, retail sales accelerate, and that is when we can start looking deeper into the consumer aspects of the mid cap. So something like consumer products, apparel, retail, stuff like that, right? I'm not going to mention any names to give you ideas, but that is essentially when I want to start looking into that area. Now, the ultimate opening that I'm talking about is, you could start buying the mid caps right now and probably will do well, considering that the three main drivers of the mid caps are showing flashing green lights, right? However, I'd like to get exposed where I have the best risk to reward rate. And I think we'll find that when we have first the spread spike in high yields, then second, we check the floor, right? Is the manufacturing PMI suffering from that spike, or is it still trending up? If it is, ultimate opening. And then third, we back up the truck, right, on specific names that make sense on that setup. We have the inflation confirmation, we have the yield curve confirmation, we have the PMI still expanding, and we have the opening from the high yield spreads. That is essentially where I'd say we're good to buy individual stocks. And right now, the homework is to build that watch list and react when this happens. But at least we're prepared. Now, the positioning, I believe that smart money is already staging that next move. And it's not to the upside, guys. We have the put option open interest for the MDY ETF, which is covering all mid caps. And right now it's trading around $630 a share, I believe. And put option traders think that it could go below 570 by the end of the year, right? So there's over 2,000, I believe, 2,000 put options being opened by these traders, right? And they're targeting 12 to 15% drops in the ETF, which means a correction, right? Usually, when these high yield spreads spike, this is what happens. You get a correction, not a bear market. So I would expect that these openings and put options are expecting that spike to happen before the end of the year. You're already seeing the Oracle defaults, you're seeing the credit default swap spread across the hyperscalers. So my bet is that these traders are going to be right. So whenever the mid cap ETF reaches that price target embedded into the put options trade, that is essentially where I would go back and look at the drivers, right? Is the PMI still expanding? Is the yield curve beneficial to the trade? Are high yield spreads starting to top and turn around back down? And essentially, is inflation still favorable for these mid caps? If that all combines, I'm happy buying the mid caps, right? The individual stocks that I'll be pushing out in the newsletter for premium members. Otherwise, you have this trade. Whenever MDY reaches 570 and below before the end of the year, and you have all the three marks in your favor, feel free to buy this ETF. I feel like you could do a lot of great stuff here as far as a return. Now, you have the map, you have the setup, you have the drivers, everything that could happen and needs to happen for this trade to work. However, if you want better risk-adjusted returns, this is where I start to pitch the companies and dive deeper into the companies. And not only that, I'll give you the long-short equity trade so that you remain risk and market neutral. No matter what happens, you're still going to walk out with a great outcome here. However, that is reserved for premium members only. That is where I give you the execution, the live trade, the structure, the research, the coverage. Earnings come out within 30 minutes. You have the whole spiel right into your email, right? You'll have access to me one email away. If we become good buddies, as we are with a bunch of members already, you could text me, right? One text away, ask me any questions about your portfolio, your positioning. I'm happy to answer them. And again, we are giving away 50% off for 3 months. Check us out. If you like it, you can stay and then pay the standard price. If not, then feel free to keep following the free stuff. You can still make a lot of money out of the free, such as our South Korean setup, such as the long and short metals trade that I pitched, and such as this setup right now. You can make a lot with MDY once we have the ultimate opening out of the put options embedded expectations. That's all for today, folks. I'll catch you in the next one. Good luck. Don't forget to check us out on Twitter and subscribe to the Offside Capital newsletter. See you later.